Well, there's two ways to do it. You either go out and you buy a life insurance policy, and you can, if you ever looked at a structured settlement transaction, those are pretty clear. On the disclosure statement, there'll actually be a deduction in the expense section for a life insurance policy. For reasons not related to our industry, it's getting tougher to find insurance companies willing to sell life insurance under these circumstances. So the other option is to not hedge against the risk of death and to just, ascribe some kind of value to the additional risk that you undertake by buying life contingent transactions. And the way you ascribe a risk is the rates go up. So what you'll see in those transactions is that the rate for a 20-year-old healthy individual selling structured settlement payments is going to be lower than the rate assessed to a 60-year-old smoker who's had a heart attack in the past, because that rate that we are borrowing money, that we're trying to kind of capture that risk is assessed in the rate assessed to the individual annuitant.
How do factoring companies assess the mortality risk? Do they go out and hire their own medical underwriters or hire actuaries? What type of process do they go through, just in general terms?
Yeah, we actually work with actuaries who determine who look at the pool that we've of transactions that we've kind of pulled together. They look at an individual and they do underwrite them. They look at their medical history, their criminal history, which actually plays into your risk. They look at what kind of prescription drugs you're on, your age, various factors to come up with basically a life expectancy. But even if with the life expectancy for the individual is 40 years, we always recognize that there is some level of additional risk that anyone could pass away before the end of the period. So even the healthy 20-year-old is going to get a higher rate than someone who's selling, a guaranteed payment stream.
Right. So the preference is for the guaranteed payments. Have factoring companies or settlement funding companies, have they always purchased life contingent payments, or is that some more of a recent phenomenon?
We always have, but it's expanding quite a bit. And I think it's largely consumer demand. It's really a good estate planning tool. If you are an individual, we see this quite a bit, individuals who have life contingent payments, and that's a potential for a payment stream. And they have a family to support and a mortgage to pay, and they're concerned about estate planning. What happens to me if I die and my family does not have these payments to live on? So we do get some sellers who just come to us strictly to turn that potential cash into a guaranteed lump of cash that they can use to pay off their mortgage or something else. And we're seeing the consumer demand greater now that people understand our product a little bit more.
Great. Well, that's an excellent answer. Do you have any further thoughts, just in terms of wrapping this up, any further thoughts that you think might be helpful for our viewers and listeners regarding life contingent structured settlement payments? We don't want to give away your full speech for the NAS meeting, but do you have any further thoughts that you think might be useful, at least to give people a taste of what's to come?
Yeah, well, what we're going to be talking about quite a bit in our talk in October is a lot of going into the details about the rate. The rate that we do that is assessed to the annuitant presumes that the person lives the entire time period. If we have an unhedged transaction, if the seller dies before we receive a single payment, the company is out the entire lump, the entire amount of money paid to the annuitant. So there is